the highest increase in fruits and vegetable prices in U.S. history occurred in July, over 40%. All those things mean you need to devalue the dollar.
Red Cloud Financial Services is your preeminent source for mining industry opportunities. The team provides a unique, tailored marketing program dedicated to reaching the right people from its mining-focused global network, giving clients access to industry-leading events and conferences, retail and institutional marketing, plus an in-house growth-driven digital agency. Red Cloud Financial Services has access to some of the mining industry's most notable companies and CEOs.
Hello and welcome to this live core conversation brought to you by Red Cloud Financial Services. I'm Mark Bunting, the host of RCTV. Thank you very much for joining us today. We have a great guest lined up for you. If you have any questions, you can put them in the comments section in the right-hand side of your screen, and we'll get to as many as we can toward the end of the show. We are talking to a gentleman who recently joined Red Cloud Securities. He is Ken Hoffman, Commodities Strategist. Let's bring him in here. Great to see you, Ken. Thanks for joining us.
Great for having me. Thank you so very much.
Now, by way of introduction, for those who may not be that familiar with you, let's get to know you a little bit better. You have a long career in the commodities sector. You worked at Bloomberg Intelligence. You also had quite a lengthy stint over at McKinsey as the head of global battery value chain. So could you give us a little sense of your background?
Sure. I go all the way back to 1991 when I first became a metals and mining analyst for a small firm called Prudential Securities. Spent a decade at Prudential. Became one of the few analysts to travel the world from the U.S. So I was a regular going to Asia, been going to China since 1994. I've been there more than 100 times and pretty much realized that when you need to understand the world of metals and mining, you have to understand China. Actually, just 2 weeks ago, I was in China as well as Australia. And then I went to become a portfolio manager. I ran a small energy and basic material fund, about $300 million, called the Orbitex Energy and Basic Material Fund, top quartile. Then I worked for some big, ugly hedge funds, such as Millennium Partners, and ran research for an activist fund that was in the industrial space. Before then, as you say, going to Bloomberg, I started Bloomberg Intelligence. I think I was number 5 on their team. Today, they have close to 1,200 people there. And I sort of ran the group of analysts that we had there looking at metals and mining. And as you say, then I went to McKinsey, where I sort of married my financial background with the consulting world and helped a lot of companies understand their strategy and how they should act going forward.
Well, that's quite something, and a lot of variety there. And the fact that you've been to China 100 times or more is pretty incredible, going back to 1994. So let's start there. You mentioned you just came back from there, spent a week a few weeks ago, and we'll get into your report, which you came out with a while ago with Red Cloud Securities, talking about the trends that you're seeing. But before we get into that, you mentioned that you one of the times you visited was 2015. And that was when you were with Bloomberg, and the headline of a story based on your report was something about we spent some time in China. I'm paraphrasing, you can correct me, but something about we're kind of terrified by what we're seeing. So can you compare and contrast that visit 10 years ago with the visit just a few weeks ago, and what's different, what's the same, what's changing?
Sure. Back then, when I was at Bloomberg, I actually was an advisor to Peter Grauer, who is the chairman of Bloomberg, and he was on the board of directors of Glencore. And so he often would send me out to try to have an independent view of the worlds of metals and mining and commodity trading. And this was one of my trips to China. I got a bit lucky in that I ended up attending a conference in Wuhan which is infamous now. But back then, I had a huge metals and mining conference, and I turned out I was the only English speaker in the audience of 900 people. And I knew that because when I would walk in, the translators would put on their headset, and when I would get up to leave for some reason, they would take it off. But in that meeting, they talked about how China was in a really dire straits. I had been talking to taxi drivers the whole time I was in China, saying things were never seen it this bad, and a lot of late night conversations with people where you can sort of get the real feel for the economy. And I saw things really slow down terribly. The other interesting thing at that time, which I think is a corollary, is at the time, President Xi Jinping came out and had a huge crackdown on the government spending. And so you saw a lot of social activities all canceled. They couldn't go out. They couldn't spend on Motai. They really were told, like, look, we're clamping down on all sorts of excesses. And that is something that I saw this time. Now, it's not quite as bad as I saw it back in 2015. And I came back, wrote a report for Bloomberg Intelligence, and then a reporter called me up and came up with a quite dramatic headline. What was interesting in the aftermath of that is Glencore came out and said, no, this guy has no idea what you're talking about. We're Glencore. Why should we listen to some silly analyst? The price of copper collapsed that summer, along with Glencore, who almost went into default. Things got so bad. And so it turned out to be probably the best call of my career. But I think understanding China and what's going on in China tells you an awful lot what to expect in the world today. And I think that continues to be true.
And Ken, just as an aside, do you speak a bit of Mandarin or Cantonese?
Very, very little, enough to get me in trouble. But no, my language skills are a bit limited. So I usually do go over there with a translator. I had a translator at Bloomberg who was actually a senior translator in the Chinese government. And so she was able to get me into a lot of places back then to understand what was going on in the economy. And they were quite forthright at the time. I think people think China is just gigantic monolith. But when you go over there and spend some time over there, you can really learn some interesting things to really help you understand your investments in the commodity space.
Well, that makes a lot of sense, of course, to have a translator so you're not flying blind and you know what's going on. So let's get into your report. Let's start with gold. We know that just by the numbers, China's central bank, after and even during, I guess, the financial crisis of 0809, started ramping up their purchases of gold, and they've just continued to do that. And one of the headlines in your report is that China still loves gold, which I think is a little play on Austin Powers and gold member probably. But is this primarily because they wanted to diversify away from the U.S. dollar, or are there more factors at work as to why they're buying so much gold?
Yeah, I mean, I think a little bit of history to go on with gold and where we are in gold, because I see a lot of analysts, and I do not agree with their analysis of the gold market. Remember, after World War II, and I have to give a little bit of a history lesson, the U.S. was supreme. And so the U.S. basically became the basis of global currency with gold, gold standard. That lasted for almost 30 years until we got into the early 1970s when the thing people love about gold and being a gold standard is it only grows about 3 to 5% a year in terms of new production into the world system. And so my currency is tied with this. I can't overspend. And they were really afraid of, remember in the 1920s and the 1930s, we had boom bust cycles, we had tariff wars, we had all sorts of bad things going on. And the economy was very fragile and you would see these terrible recessions. After World War II, the U.S. said, wait a second, we're going to go on this gold standard. The U.S. is going to be the supreme currency. In 1972, the U.S. had the Vietnam War. We ran massive deficits. We needed to run the printing press full out. So that's when President Nixon came out and said, no more gold standard. And really from 1972 to 1980, we saw about a 25-time increase in the price of gold from around $35 to about $800. And President Reagan came in and sort of said, wait a minute, we need to reset everything. We need to make the U.S. dollar, again, the main currency of the world. And he had something called the Plaza Accord in 1985 and recentered the U.S. dollar, not backed by gold, but the U.S. dollar was the head of currency. Fast forward to 2000, 3/4 of all trade in the world happens with dollars, and dollar was supreme. But then we had some things happen. We had 9/11, we had the great financial crisis, we had COVID. All of those things caused the U.S. to overprint money, and all of those things decreased the value of the dollar and decreased the amount of dollars being used in the world. So from 3/4 of all trade in 2000 being the dollar, this year it's only about 52, 53%. And of course, we've actually entered a period where the US really is pulling back from the world. We have these huge increases in tariffs from 2% to almost 20%. The US is going to really pull back from the world, which means less and less dollars needed in the world order. I need to replace what I used for the dollar. And what central banks around the world, investors around the world are saying is gold makes a lot of sense here. And so when people say to me, when we're talking about a $10,000 gold price target, that seems a bit excessive. I'm like, no, you don't understand. The macro trend here is a huge changing of the world order being forced by the United States right now. And so that plays perfectly into the hands of gold, and why gold is today about $15 from an all-time high. And I think it will continue to go significantly higher. These trends are sort of unmistakable.
That's a great history lesson you gave us there. Now, as far as your report, we're going to take a look at a chart here, which is really good. It goes back 25 years comparing the US dollar to gold. And you say there's a possibility, or maybe let's call it an if scenario, whereby the US dollar could revisit its 2008 low and or 2011 lows. What factors would drive the dollar to those levels, and how realistic is it that would happen?
So remember, again, going back to the US dollar, the idea of pretty much going back to President Reagan is we were going to open up the world to free trade. And so you saw global tariff costs come way, way down, and force people to use the US dollar in trade. That forced central banks around the world to have dollars because there was more trade, so they had more dollars. They would invest it into US treasuries, which was basically funding our deficit. And we would go out and protect the world with our military. All of those things are being undone at the moment. And so what we see happening right now is a lot less global trade, so less need for dollars, but at the same time, huge deficits. There's something called the Mar-a-Lago Accord, which has been talked about a lot in the press, where Trump has said he wants to devalue the dollar. It's part of the reason why he's trying to take interest costs down. If you take interest rates down, then there's no reason to hold dollars, and it will collapse the value of the dollar, which to him, he'll use those cheap dollars to pay back our deficit. However it works out, and in truth be told, we don't know, but all those things suggest to the rest of the world, if I'm not going to use dollars, if the US is trying to devalue the dollar, gold, which is priced in US dollars, will go significantly higher. Now, looking back at a chart over the last 25 years, the bottom of the US dollar was in around 2008, 2009, during the global financial crisis. And that's around 30% lower than the value of the dollar today. So one ticker to watch to verify what we're saying is DXY. It's the dollar index. It's out there on any finance ticker board, and just watch the DXY. Right now, as we speak, it's around 97.7. The low is closer to 70. And so what we've seen already this year is a 10% decline in the DXY has meant a 30% increase in the price of gold. And using that 3-to-1 ratio, which is historically pretty accurate, if you see a 30% decline in the value of the dollar, you should see pretty much a doubling in the price of gold. That gets us to around 8,000. And then I think there'll be a momentum play behind that will send us high, because gold tends to overshoot on the upside. So I think that's where you get to 10,000 or even more.
And is that a multi-year scenario, Ken, if it happens?
It could happen quicker than we think. I do think you're going to see U.S. deficits continue to go significantly higher. There is a lot of carry trades going on in the world, which could unravel, which is using the US dollar as a long versus shorts in other currencies, particularly the Japanese yen. So you could see a scenario where all of a sudden things start to unravel really quickly. And you're starting to see the beginnings of that. For example, the price of fruits and vegetables in July rose 40+% in the United States, mainly due to all sorts of trade wars and kicking immigrants out who were picking the fruits and vegetables. But the highest increase in fruits and vegetable prices in U.S. history occurred in July, over 40%. All those things mean you need to devalue the dollar. And I don't really agree with this idea that tariffs are transitory. And, inflation in the US is going to calm right back down. It doesn't work that way. If I'm an employee right now, I'm going to the supermarket and paying a lot more. That means I'm going to go to my employer and say, I need to be paid more. And then the employer has to cover those costs. So he raises his prices, and it's just sort of a really bad scenario that goes higher and higher and higher. All those things combined mean the dollar needs to devalue itself versus other currencies around the world. And again, since gold is valued in dollars, it's a very, very strong indication for why you want to own gold.
And we're looking at that chart right now. The yellow line is the US dollar, the white line is gold. And again, that goes back 25 years. So that's fascinating stuff. And just quickly here before we move on to something else, UUP, the ETF, that tracks the US dollar. Do you know, does that track DXY, or is that something different? You know?
It should. There's a number of dollar indices. I know Bloomberg has a dollar index. They all generally are the same. It depends. Some are weighted to trade. Some are just a general basket of currencies. I know the DXY is a little bit more euro focused. The Bloomberg index, and I'm not exactly sure this index, but you can see the weighting. Some are more Chinese yuan based. So it's sort of, they all tend to move in the same direction, but it sort of depends. But you can see from this chart that you see gold going when the dollar was 120 from around $250 an ounce to $1,750 an ounce when it bottomed at back in 2008. And so we're going again to see a devaluation of the dollar, which again should send gold ripping higher.
Okay, let's move on to batteries, your field of expertise. Not that what you're talking about is not your field of expertise either, but you really do specialize in this area. And one of the things you say in your report is that manganese used in battery chemistries is moving at what you say is hyper speed, but it can't just be any old manganese. It has to be high grade and low cost. So can you elaborate on the significance of that?
Sure. And, Red Cloud, we put out a research report 2 months ago saying that lithium had bottomed and would go significantly higher. Fortunately, we were right. You have seen lithium rip higher. And again, it all goes back to why were we right on that? We focus on China. Chinese battery production this year is up more than 60%. And that's based on stationary storage. One of the things that we've seen, the reason why stationary storage explode higher is the cost of batteries have come lower. How can I make the cost of batteries go even lower still? And that is to change the composition of the metals that are in there. So today, the low-cost battery is called LFP, which is iron phosphate. Iron's really, really cheap. Phosphate's really, really cheap, and that battery chemistry is really cheap. If I wanted to make a battery that had significantly better attributes, specifically having more energy density and a higher voltage, the metal I would go to, you have two choices. You could do nickel and cobalt, which in nickel cobalt batteries are quite significant battery chemistries, or I can go to manganese only, a manganese iron phosphate. Manganese trades for around $2,000 a metric ton in the West versus $15,000 for nickel and $30,000 for cobalt, yet gives the pretty similar attributes in terms of energy density and voltage. So in what we've seen in China, and again, China tells you what's going to happen in the rest of the world, here's some crazy numbers. Manganese being used in batteries, manganese powders produced for batteries, was just 1,000 tons in 2023. It was 10,000 tons in 2024. In the first 3 months of this year, it was 25,000 metric tons. And just coming from China, the numbers they're looking at is the total number for this year will be around 250,000 tons and at least 500,000 tons next year. So a huge explosion in this. The reason for this is the Chinese have improved the technology on how to use manganese in the batteries. And since it's so cheap, everyone is rushing towards there. But again, I think to take advantage of it from an investor standpoint, you just don't want to buy something with the name manganese in it. You want to make sure, do they make the high purity, low cost manganese? And can they actually make the powders that the cell makers want to buy? And so if I'm General Motors, they announced something called LMR, which stands for lithium manganese rich. And so can I make that powder to sell to General Motors? And there are some companies out there that you could find that are starting to do just that. But I think that's going to be a really important trend, which is great for manganese. But remember, if I'm going towards manganese, it's probably going to hurt nickel and cobalt because I'll use less nickel and cobalt in these batteries.
Right, you refer to that in your report. So do we see over time nickel and cobalt essentially eliminated from most batteries? And is this happening rapidly?
It's happening very rapidly. Cobalt already has been reduced dramatically. If I looked at batteries from 6 years ago, the weight of the batteries in terms of the cathode, batteries and anode and cathode, and the lithium bounces back and forth. On the cathode side, it used to be a third of the battery weight was cobalt. Today, it's only about 3-4%. That number continues to be reduced. And if you do look at the General Motors LMR battery, lithium manganese rich, or what Volkswagen is doing, that has no cobalt in there. So will cobalt completely be eliminated from batteries? Probably not. You need different batteries for different purposes. And I think that's the one thing a lot of analysts got wrong this year. They were so focused on EVs, and their analysis was, well, Trump hates EVs. It's not going to sell in North America. Therefore, the battery industry is dead. No, there is batteries needs for stationary storage, which again, I think is going to be and has been absolutely massive. And I don't even look in our analysis at robots, drones, things of that nature, which are seeing growth, but we don't know when there's that tipping point where they just explode to the upside. So there's so much interesting battery technologies, and they're all using different chemistries for different attributes. Some need to be high altitude, some need to work in the really cold, some need to work with a lot of power, some need to last a long time. So all those things are quite interesting. And yes, you put up the chart here of manganese, you can see it's come from nothing to be quite explosive. And even when I showed this to some of my colleagues in China, they're like, you're too low. So it is really interesting what's going on, and whatever happens in China happens in the rest of the world. Like I said, you'll see it first in China in a very big way this year and next year. And then General Motors LMR battery is going to start to come on the market 2027, 2028. That's going to give you longer range vehicles at lower cost, which everybody wants.
And just to be clear here, we're looking at the lithium manganese iron phosphate powder, and you call this growth and potential growth just staggering, right?
Yeah, when China changes their battery chemistry, they change really fast. The ultra competitiveness of the Chinese market tells you something. And I go back to the days when I was at McKinsey, and back then, most of the batteries used 50 to 60% nickel and 20 to 30% cobalt. And a new chemistry started to see, you started to hear it when I went my trips to China, which was 80% nickel and only 10% cobalt. And so people sort of said, well, it's going to take a long time. And I would argue with my colleagues at McKinsey saying, China's going to do it fast. And they said, no, Ken, you don't understand. There needs to be a lot of testing, and it's going to take maybe a decade from now, 811 will start to be maybe 5% of the market. Well, 2 years later, 811 was 90% of the market. And we were really caught flat-footed at McKinsey. So when the Chinese move, they move really fast. And right now they're moving really fast on this high manganese powder.
Now, before we leave manganese behind and move on to another topic, we're not looking to you for stock picks. You're a strategist. You're not. That's not what you do, and maybe even compliance reasons you can't do that. But you did hint at certain types of companies that are in that space. So where does one look at the high end of the BHPs and the Vale types, or are there more sort of specific manganese companies?
There are some companies out there, what you would look, and they're generally smaller companies, but there are companies out there generally coming either out of Canada or Australia. And you watch them and you'll say, in their reports, they're saying, we're not only going to make the high value manganese battery material, but we're also going to try to convert that into LMFP and LMR powders. And so those countries, and what's really critical about why it's important they succeed is you'll always hear this case, why isn't there a value chain outside of China? And I worked on a manganese project when I was at McKinsey, and they were going to produce the manganese powder in a NAFTA country. And then what they were going to do is they were going to ship it all the way over to Korea. And then in Korea, it was going to be used with different powders in copper and lithium and cobalt, and then shipped back to the United States, where it would go into a plant and be made into a battery. And I think, you've seen things like 90,000 miles it takes for materials to travel to get into your vehicle. That's the type of stuff we need to stop. And so if I can at one plant make my manganese and then take that manganese with iron powder and make my LMFP powder and then ship it to a cell plant, first of all, I cut a lot of cost out of the system, a lot of travel out of the system. And I think that's what companies are coming out and saying they can do it. And so watch for those type of companies, because that's going to be sort of the next leg up, where Western companies say, look, I don't need to go to Asia and back. I can do it in my own backyard. I can reduce costs and give a better battery to the marketplace.
I did a quick search of my own today looking for public companies that are engaged in manganese, and there were numbers of them that came up. And most of the names I wasn't familiar with, but that's something investors can do on their own. Let's move along to copper. You're saying that copper could have a tough year in 26, but then will likely roar back in 27 as the electrification of the world continues. So 26 will be a struggle because of delayed impacts from tariffs. Is that your case?
Yeah, I mean, the tariffs that the U.S. have used, and really we are using in the United States tariffs as a weapon. You've seen this, 50% tariff on Brazil because we didn't like one of their politicians going under trial. We put 50% on India because we didn't like them buying Russian oil. These are traditional, not reasons you use tariffs. But all of these things, what they're doing is they're really slowing down the global economy. And again, the tax on the U.S. consumer going from a 2.3% average tariff to nearly a 20% average tariff is already starting to show up in the numbers here, with very large inflation numbers. And I think those things really cascade into 2026. Remember, the U.S. consumer has always been the driver of global economy. You always hear that in speeches, that the driver of the global economy is the U.S. consumer. These tariffs are directly impacting the U.S. consumer. They're going to consume a lot less because of these higher costs, and therefore you're starting to see this. You've seen companies like Home Depot and Lowe's already say that the purchases of large purchases, things for appliances or doing large-scale projects, have already dialed back massively. You are seeing, as I said before, all-time record inflation in things like fruits and vegetables. Already beef prices in the U.S. have gone up dramatically as well. You don't realize that we import a lot of these things. And so I think that is going to put a chill on the entire global economy. What's scary is you did see even China put a tariff on Canada because they didn't like some of the EV policies from Canada. If this is going to become a world where tariffs are used as sort of an economic weapon, that puts a huge chill on the economy. And I think that really hits in 2026. And what makes it really difficult for an analyst is I think consumption of copper, particularly in the US, is going to drop a lot. I think it drops about 6% next year. The hard thing from an analyst is I just talked about the dollar devaluing. And since copper is valued in dollars, if you saw a 30% decline in the dollar, that would mean maybe a 30% increase in copper, even though demand could be down. And so it's a really tricky time. I have to give an opening speech at the London Metal Exchange in October, and I'm really still trying to get my head around all of these factors. And look at this year, the dollar has declined 10%, copper price is up 10%. Is that saying that copper's having a good year, or is it just sort of treading water? That's going to be a bit of the factor going forward. But I think demand for copper drops significantly next year before completely roaring back in 2027.
Okay, very interesting. We'll be watching for that. Now, Ken, you touched earlier on stationary storage, and more specifically, battery energy stationary storage, and the acronym is BESS, B-E-S-S. You say it's the fastest growing segment in energy storage. So can you explain the significance of that?
Sure. And again, the reason we were, happened to be right on the lithium price 2 months ago is I was really looking at China, and I was looking at their battery production. And year to date, their battery production was over 60% higher, even though EV production is only up around 10%. And you say, how can that be? It's all stationary storage. And here's what's going on. You probably saw a few months ago where Spain, basically the entire country shut down, their grid collapsed. Part of the reason for that is Spain, if we look at AI, or these artificial intelligence server farms, where are they building the most of them in Europe? In Spain. And these things use a tremendous amount of electricity. It's funny, you used to hear years ago about EVs are going to collapse the grid. You don't hear anything about AI, but AI will collapse the grid and did collapse the grid. Now, the only way for people to get around all these server farms being built and all the electricity that they're using and the fragility that they're putting on the grid is to make sure I have a lot of energy stored just in case. And that's stationary storage. And so the price of stationary storage has collapsed. I remember years ago seeing a wind farm company in China, and they said, look, stationary storage costs are about $650 a kilowatt hour. Doesn't make sense for us to do it. But if it ever dropped below $250, we would invest like crazy because it would lower the overall cost of the wind farm. If they could run, it'll be windy and you'll see a windmill and it won't be working. You're like, must be broken. That's really weird. What it is they've purposely shut down that windmill because it can't take all of that power coming off of it. However, if I could put stationary storage right next to that windmill, I could soak up all the electricity out there. And so I think this is what's going on is where are we today in stationary storage costs? Under $100. And so everyone around the world is saying, wait a minute, the grid is becoming more and more fragile because of AI. We're building AI like crazy. I think NVIDIA came out and sort of again said that they're just selling these servers like no tomorrow. So because of that, all the grids around the world are saying, how can I add backup storage capacity? And I think it actually becomes as big as EVs by 2035. It was 8% of EVs in 2020 in terms of battery production for stationary storage versus EVs. It was 40% of EVs last year. It will be more than 60% of EVs this year. That's what the analysts missed. That's why they were wrong on lithium. It's because they were only so focused on EVs. They didn't realize batteries are in a lot of different applications. This year, it's been stationary storage in a really big way. And that's why lithium prices have rebounded as strong as they have.
Sticking with lithium, we had Rick Rule on a while ago on one of these live core conversations, and he says he loves hated sectors. I asked him what he's sniffing around, and he said lithium, and this is a month or two ago, if not longer. And so would you say we've seen the price of lithium move up rapidly? We're looking at the likes of Albemarle and other companies like that. Their stocks are doing better. They've come to life after a long downturn. So would you say the sector has already turned and it's a good time to look around at some certain investments?
Yeah, I mean, definitely lithium has a lot more ways to go. Remember, I mean, lithium prices came from $80,000 a metric ton down to $8,000. So a 90% decline. Most lithium producers need a price between $15,000 and $20,000 to make an economic profit. We have rallied from 8,000 to 12,000, so we've come a bit of the way. But I think longer term, we need to be in that 15 to 20 range. What we don't want from lithium is we don't, again, want to see prices, say, above 30,000. While I'm sure investors would say, wait a minute, I want the highest price possible. One of the things you have to worry about is when that price gets too high, it incentivizes other batteries. Remember, electrons can be held by a lot of different things. So while I don't think at current prices sodium-ion batteries make any sense whatsoever, if the price of lithium went too far on the upside, I'd be concerned because then a lot of research and development will be put into sodium-ion, and perhaps they could become more of a threat. And so I love prices in that $15,000 to $20,000, $22,000 range, and make sure the lithium companies make really good profits, but it doesn't kill the golden goose. You'll still see a lot of lithium being used in battery technology.
We have seen booms and busts in lithium, as you know, going back 8 to 10 years. So do you think the current situation means that perhaps there'll be less of a boom bust effect, or is that it's hard to gauge?
Remember, the reason why we've seen the boom and bust phase is one, it's still a very small industry. I mean, we think nickel's small. It's about a 5 million metric ton market. Lithium market, 10 years ago was 150,000 metric tons. It's grown tenfold. It's about 1.5 million metric tons this year. So the bigger it gets, the more production that's out there, it helps. But it's still a really small market. Long term, first of all, we don't have to worry about lithium. The earth has plenty of it. There's about 5 times as much lithium as there is copper, and we produce 22 million tons of copper a year. So I'm not worried about lithium in terms of being in the earth, but getting it to market's a real problem. And having the refining capability to make high quality lithium is very difficult. And that's sort of what we've seen, where demand grows really rapidly. And it takes a while for that refined capacity to catch up. And then when it does, of course, too much is built and then we sort of collapse. We're in that part right now where there's actually capacity still being shuttered because it doesn't make money, while demand is up huge. And that's a fear of mine, is that in 2026, 2027, we do see that lithium price spike again. And again, I as an analyst, I want to see nice, steady, high enough prices that everyone's happy, but not those real spiky prices. I don't like that on a long-term basis, because it incentivizes other competitors.
Okay, Ken, one more question from me, and we have at least one question waiting in the queue from a viewer. So again, with the caveat that we're not looking for stock picks, but based on what you've been saying here in terms of China's influence on gold and manganese and copper and lithium, do you have any thoughts on the types of opportunities, the kinds of companies investors may want to investigate?
Well, first off, you want to buy pretty much every gold junior out there. Gold stocks have not reacted with the price of gold. If I just were to look at gold margins, say the the JDXJ, which is a junior index. There's a lot of junior indexes out there, but the one I follow for my career is the JDXJ, which is a junior index. It's around 80. If I looked historically on where gold prices were, where margins were in the gold industry, where should these equities be trading, the number is at least 200 to 300% higher than where it is today. So the value of that gold in the ground is just not being valued by the market. I do think what you'll see is some pretty good acquisitions in this space. Maybe some of the larger gold companies get acquired by the big mining companies, because they're going to see how important gold and copper are to the world economy. And I think that will really start to trickle down. But to me, the cheapest part of the market today is the junior gold miners. I think they're just unbelievably cheap. As you look at other things, you need to do your own research. Some of those companies who are going to make those manganese powders in the West are really interesting to me. And copper, I think you just have to be particular. When the market next year isn't very good, and you start to hear about, tariffs being bad and everything else, it's really slowing down the world economy. That's actually going to be the time to buy. I don't think it's today, but I think it's going to be at some point in 2026. You can get really excited. We'll give you updates here at Red Cloud. But I think that's going to be the way you play the market going forward.
I'm just looking at a long-term chart of GDXJ. In 2010, it peaked at $166. It's just within, I guess, the last several months really started to move. It's up at 77, but way off the highs, as you alluded to. And we've had many guests, many CEOs wondering when the heck some money would trickle down to the juniors. It looks like it's finally starting to happen the last several months, even going back to a bit of 24 as well. Okay, so let's get to this question here from Wes Roberts. What is your view of vanadium for storage batteries? Does it have benefits over lithium? Wes seems to believe so.
So I love vanadium, but not for the reason Wes is thinking. I'm not a big believer in vanadium flow batteries. In fact, I think they're relatively inefficient and they have all sorts of problems. However, vanadium is unbelievable as a cathode material, much like nickel and manganese, as we've spoken about. It's a private company, so I can say it here. There's a company in the US called Pure Lithium. They actually have developed a vanadium iron battery that gets double the amount of density of any other battery out there. And the best thing about vanadium is it doesn't have a thermal runaway event. And so you can see it in a lot of niche applications where you have a zero chance of thermal runaway. So no matter what the temperature of the battery basically is, it will never go into thermal runaway, cause a fire. And so the idea that vanadium is incredibly energy dense and has this thermal runaway, you will definitely see vanadium become a really important material. Now, will it become as big as nickel or manganese? I'm not sure. It's a couple $2 billion to bring a major vanadium asset to the market. You're going to need significant amounts of vanadium, and so we'll see. But in terms of, it is a relatively common metal in the Earth's crust. It's mainly just used for steel today. But I think as these batteries get proven, and how important they're going to be, I think investors will say, yes, we want to invest in vanadium. But that's a great question, because I think vanadium is completely misunderstood in the battery landscape and will become huge as the battery development goes forward. because it has such a great density profile and thermal runaway profile.
All right, very good. We just got a couple of other questions here. This is from Eugenia Origi, I believe. I probably mispronounced that. You described what you saw in China and the economy in 2015. What did you see in your trip in the last few weeks? I think you kind of covered that. Is there anything?
I did. I mean, there was a couple things that disturbed me. One, simple, and again, I'm one on on visual clues. When I flew into Shanghai, I saw a lot of empty boats, and they were all iron ore boats. And I was asking some people around, and they're like, the steel mills here are running at very low capacity, and so that's telling you the Chinese economy is slowing down. The other thing, as I said, is we had some of the people I was with. I'm too old to go out and do karaoke, but the people I was with were younger than I, and they were going out and they were saying that the karaoke bars, which are normally filled with a lot of government employees lavishing spending, were empty. And they went to several places in several cities, and it was all the same thing. And they said, yeah, the government's huge, cracking down on corruption. And again, they tend to go down on corruption when the economy's sort of in bad straits, and they just don't want the populace to see government officials living on the high life, spending high on the drinks and everything else in these clubs. And so the clubs are really in bad way. Even one of the clubs said, you can't come in because we think there's a government official with you. And they were afraid of maybe being raided or something like that. So that just tells you China's not in great shape. Now, it's not as bad as I saw in 2015. You did see construction occurring. Back then, all the cranes were stopped. So I think it's not nearly as bad as 2015. But again, I don't think it's good for the global economy.
Well, that's what we're looking for, that kind of boots on the ground knowledge that you're giving us right now. Okay, this is from Cabello Mojinaga. In your view, what is the forecast price for manganese battery grade for 2030? You said currently it's around $2,000 a ton.
So the reason why OEMs love manganese is, consider this, nickel production is around 5 million metric tons a year. Manganese production's over 20 million metric tons. It's around copper. And so the reason why OEMs have been pushing so hard for a solution that uses manganese is it's so plentiful. They've seen how lithium prices go, and lithium right now is 95% of the demand comes from batteries. We saw how nickel had really volatile times when we saw huge increases in NMC nickel batteries going forward. And we've seen cobalt have spectacular volatility as well. So the automotive companies have really been going to the chemist and saying, can we find a relatively plentiful metal that looks good on the periodic table and we won't see these crazy prices? Manganese fits that. I mean, our numbers are probably double by 2035 battery demand, because I do think there'll be many other uses of batteries that people don't really see today, be it consumer goods, be it robots, be it drones, be it stationary storage, etc. So even if we use really, really high numbers by 2035, you'll need about 5.4 million metric tons of manganese. I think that helps the manganese price, but I would believe that that $2,000 number probably will be around $2,000 in 2030, 2035. Now, the companies who make that manganese will have huge margins, because remember, manganese ore is only a couple $100s a ton. So there's huge margin even at 2,000, but I don't think you're going to see manganese prices explode the market. It may have some sort of impact, but even at 14 terawatts of demand in 2035 versus around 1.5 this year, you'll still only use about 25% of the global manganese market. So we have 25% of the manganese market, but on a value basis, it will probably be about 60% of all the value of manganese. Because again, steel manganese is just a couple $100s a ton. Battery grade, particularly the LMFP powder, sells for around $7,500 a ton. So there's a lot in that value chain to make great profits.
Really interesting, Ken. Is there anything that we haven't touched on that you want to get at?
I just, again, would be really nimble here in this marketplace. You're going to hear a lot of things. I'm very afraid of the stock market in 2026 and the economy in 2026. There's a lot going on here that is not normal. And when you start to see the world acting not normal, things tend to get a bit crazy. And so I think from that standpoint, investors need to be careful. I think gold is a great place to hide. Again, don't jump on copper too soon, but do know that the boom in copper and other things are coming, and we'll really try to work with our clients to try to help them understand where we are in this cycle and how to take best advantage, because I think we're going to need to be nimble here.
Ken, that was a real education. We all learned so much. Really great to talk to you, and we'll talk to you again. Thanks for taking the time today.
Thanks so much for having me.
Okay, that is Ken Hoffman, Commodities Strategist at Red Cloud Securities. Thanks for watching. Thank you for your questions, and we'll see you next time. Take care.